I'm Ron Rowland with Money and Markets TV. The catastrophe in Japan has rocked the global markets this week. On a human and economic scale, its impact is likely to be much worse than Hurricane Katrina's was on New Orleans. One thing New Orleans didn't have to worry about was the nuclear power plant getting damaged. Several of them are now in various stages of meltdown in Japan. The impact on ETFs was immediate, bearish for some and bullish for others. Not surprisingly, funds related to nuclear energy saw the most dramatic moves. With oil prices around $100 and heading higher long term, you might think the nuclear energy industry would have good prospects for growth. And you would have been right a couple of weeks ago, but not anymore. As Martin Weiss pointed out earlier this week, the Japanese reactor damage is far worse for the industry than 3 Mile Island or Chernobyl. Those earlier incidents could plausibly be blamed on outdated design and lax oversight. But not so with Japan, where nuclear power plants are highly regulated with a stellar safety record. That reputation is now in ruins, and it is hitting the nuclear power industry worldwide. In just 3 trading days, the global ex-uranium ETF tumbled nearly 30%. URA took the biggest hit since it is so closely tied to world uranium prices, but other nuclear-focused ETFs sponsored by market vectors, power shares, and iShares are way down as well. Now, I won't be surprised if some of the selling was overdone in a momentary panic. We may see some strong bounces in some of these ETFs soon. That won't help their long-term prospects, though. Everywhere in the world, plans for new reactors are being delayed or canceled entirely. Older plants could face early retirement. For example, Germany has taken steps to shut down 7 of its oldest reactors. China and India have shelved plans to use nuclear power to meet a large portion of their energy needs. So, what's the alternative? The obvious answer is oil, natural gas, and coal. But the supply of fossil fuels is limited, and those industries create plenty of danger to both people and the environment too. The market understands these problems, and it's betting on wind and solar energy to pick up the slack. This week, the Market Vector Solar Energy ETF and Guggenheim Solar Energy Fund both jumped 10%. The PowerShares Global Wind Energy ETF and First Trust Global Wind Energy are also sharply higher since the disaster. On a short-term basis, the 2 solar funds seem to have much more momentum than the wind-focused funds. But here, too, we may be seeing a bit of a overreaction. Therefore, I wouldn't jump into any of these ETFs right now. If this is a major trend change, it will unfold over the next week or 2, so watch carefully. I'm Ron Rowland for Money and Markets TV. We'll see you next week.